The AI trade blinked this week. Chip stocks fell into a bear market, and IBM had its worst day since 1987. While all of that was breaking, oil jumped 16% as the war with Iran flared back up. 1 week, 2 stories, and both touch your retirement money. In the next few minutes, I'll show you exactly what fell, what held up, why it happened, and what we're doing about it inside the value-aligned portfolio. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay. He reads every comment and writes every lesson. Here's the plan for today. We'll walk the scoreboard first, then the 2 forces that drove everything, then the economic backdrop, and then the portfolio itself. 5 winners and 5 losers, all named. We finish with the 8 earnings reports coming next week and the 2 paths the market could take from here. Start with the scoreboard. Let's dive right into the performance numbers. The S&P 500, ticker SPY, closed Friday at 743.29, down 1.5% for the week and still up 8.8% for the year. Now look at the equal weight version, RSP. It slipped just 0.4%. That gap of nearly 4 points tells you the selling was concentrated in the biggest names. The Nasdaq 100 took the real hit, down 4.2%, while the Russell 2000 small caps barely budged and still lead the year at plus 19%. Volatility woke up too, with the VIX closing at 18.8, up about 25% for the week. So the average stock had a quiet week. The mega caps had a rough one, 11 sectors, and the spread between top and bottom was wide. Energy gained 4.7% as crude surged, and it now leads the whole market for the year, up 29%. Real estate and consumer staples came next, that is, the classic defensive playbook. At the bottom sits technology, down 5.5% in 5 sessions. Consumer discretionary and industrials also fell as the growth trade came off. Notice the pattern here. Money didn't leave the market this week. It moved out of the crowded AI names and into energy and defensives. Here are the week's biggest movers in the S&P 500, and the list reads like one single story. The 2 best performers were cybersecurity companies. Palo Alto Networks jumped 10%, and CrowdStrike rose 8.5%. Because cheap, capable AI models multiply the attackers that corporate networks have to stop. Chevron and Exxon each gained about 6% on the oil spike. Apple rose 5.8%, set a record high, and briefly passed Nvidia as the world's most valuable company. Now let's take a look at the losers. IBM collapsed 26%. Intel, Micron, AMD, and Broadcom all fell hard, and none of them reported a single piece of bad company news. That contrast is the whole week in one slide. 2 events cracked the AI trade. First, IBM. On Monday, the company pre-announced its quarter. Revenue up just 1%. The mainframe cycle stalled, and big deals slipping. CEO Arvind Krishna admitted, quote, "We did not adapt and move quickly enough." The stock lost a quarter of its value in a single day, the worst since 1987. Second, China released a new AI model called Kimi K3, and its efficiency claims revive the DeepSeek fear that frontier AI may need less hardware than the spending plans assume. Jim Cramer put it bluntly on Friday, "There will always be another DeepSeek." A client called Burke on Tuesday after the IBM news, asking if we should trim every tech name we own. The answer was no, and the rest of this video explains why. Underneath the drama, the economic news was good. June CPI fell 0.4%, the first monthly decline in 6 years. Core inflation was flat for the month. Consumers kept spending, with retail sales excluding gas up 0.7. Jobless claims at a 10-week low of 208,000, and consumer sentiment at a 5-month high. Then there's the Fed. New chair Kevin Warsh told Congress the central bank has, quote, "no tolerance for persistently elevated inflation." Markets read patience in his hands anyway, and futures now price just 1 hike over the next 12 months. Cooling inflation, plus a spending consumer, plus a patient Fed is a friendly backdrop for owners of businesses. One caution flag: core producer prices are running 4.8%, so the inflation fight is not finished. Now the other story. Oil. Iran's Revolutionary Guard fired on ships in the Strait of Hormuz. Tehran declared the strait closed, and U.S. forces struck targets inside Iran on Friday. Brent crude finished at $88.10 a barrel, up almost 16% in a week and about 45% this year. Every dollar of that flows into the earnings of oil producers. It also feeds back into gas prices and inflation, which is exactly why the Fed stays careful. China added 2 more jolts. Its economy grew 4.3%, the slowest since late 2022, while record exports keep pushing prices down worldwide. And its newest AI model shook Wall Street. Geopolitics set the price of oil this week, and oil set the tone for half the market. Here's how the value-aligned portfolio is built for weeks like this. We own 3 kinds of stability: energy producers with low break-even costs, insurance businesses that get paid to manage risk, and franchise companies whose cash flow doesn't depend on a single narrative. That mix did its job. Quick break for the serious investors still with me. If you want the full framework behind how we sort companies into our 3 buckets: ownership companies, monopolies and oligopolies, and cannibals that buy back their own shares, we have a video that walks through it step by step. It pairs perfectly with what comes next, because now we get to the names. 5 best performers this week, named, with year-to-date right on the screen. Diamondback Energy led, up 6.6%. A Permian producer whose barrels got more profitable by the day. Accenture rose 6.2%. The market has cut that stock nearly in half this year on the fear that AI replaces consultants, yet revenue and earnings keep growing. And this week, money finally rotated back toward it. Apple added 5.8% to reach a record. S&P Global gained 4.7%, a toll road business collecting fees on ratings, indexes, and data. KKR rounded it out, up 4.1% after announcing a joint venture for Thomson Reuters print business. Notice that 3 of these 5 are still down big for the year. We show you that on purpose. Winners and losers in the open every week. Now the most important slide of the week. Taiwan Semiconductor manufactures the advanced chips for Apple, Nvidia, and AMD. And on Thursday, it reported a record quarter. Revenue came in at $40.2 billion. Net profit grew 77%. Management raised full-year growth guidance to above 40%. And committed another $100 billion to Arizona fabs, taking planned U.S. investment near $265 billion. CEO C.C. Wei says AI demand stays strong through the end of the decade. The stock fell 8.2% anyway. Record results, raised guidance, falling price. When price and value diverge like that, long-term owners pay attention. Weeks like this are where future returns get planted. The 5 worst performers, and every one of them is the same story wearing a different ticker. AMD dropped 11%, Taiwan Semi 8.2%, Broadcom 7.3%, Tesla 6.6%, and ServiceNow 4.2%. Not one of these companies reported bad news this week. AMD is still up 131% this year, even after the drop. Tesla just posted record deliveries, 480,000 vehicles in the quarter, and reports Wednesday. ServiceNow keeps growing revenue near 20%, while the market prices it for AI extinction. What changed was the mood, and mood is not evidence. Positions were already sized for this kind of volatility, so we hold. We watch Wednesday's reports, and we let the businesses speak. Next week is the busiest of the quarter for us. 8 portfolio companies report in 3 days. General Motors leads off Tuesday. Wednesday is the marquee day, with Alphabet, Tesla, ServiceNow, and Medpace all reporting. Thursday brings Roper, Kinsale, and Thermo Fisher. Beyond earnings, we get home sales, the PMI surveys, and then the Fed meets July 28th and 29th. I was working with a client last month who wanted to sell ahead of a busy earnings week just to avoid the swings. We walked through his holdings one by one, and what he actually owned was 8 businesses about to tell us how they're doing. That's information you want, and we'll cover every report. 2 paths for next week, and I'll give you both. The constructive one. Alphabet and Tesla deliver solid numbers with confident AI commentary. Chips stabilize after a 20% drawdown, oil settles, and the rally broadens out. A darker one. A second wave of guidance disappointments confirms IBM was the first domino. Kimi K3's benchmarks hold up and force hardware forecasts lower, and Brent pushes toward $100 right before the Fed meets. Which path wins probably comes down to 2 earnings reports Wednesday night. We don't predict, we prepare, and the portfolio is built to live with either outcome. 3 takeaways from the week. 1. The AI trade got stress tested and price corrected while demand did not. TSMC's record quarter landed the same week the chip index entered a bear market. 2. The macro backdrop quietly improved with the first monthly CPI decline in 6 years and a patient Fed, though oil's 16% surge says the inflation fight isn't over. 3. Rotation is healthy. Equal weight beat the cap-weighted index and small caps lead the year, which means the market is gaining breadth and breadth is strength. Before you react to anything next week, run it through one filter. Did the evidence about the business change or just the mood? If you got value from this review, you're going to want the one right here, where I break down the 3 buckets framework, the exact way we decide which businesses deserve a place in the portfolio.